Good morning, everyone, and welcome to the Morning Bell. I'm Robert, and it's Thursday, February the 12th, 2026. Joining me as always are Lizzie and Steve. We've got quite a bit to unpack today, from some intriguing developments in the tech sector to what's happening in the crypto markets. Lizzie, let's start with what's been dominating the headlines. What's catching your attention this morning?
Thanks, Robert. Well, there's a lot happening across multiple fronts, but I want to start with something that's creating real concern in the market, and that's the infrastructure question around AI. We're seeing headlines about big tech's accounting practices, creating what some are calling a blind spot in the AI boom. And more importantly, there are growing worries about whether our electricity grid is actually ready to handle the surging demand from all these data centers. This isn't just theoretical anymore. When you look at the capital expenditures these companies are pouring into AI infrastructure, we're talking about unprecedented levels of investment. But the question is whether the supporting infrastructure can keep pace. On the corporate front, we saw some notable moves. Schroders agreed to a £9.9 billion takeover by US investment manager Nuveen, which is a significant consolidation in the asset management space. Mercedes reported earnings that were hit hard by $1.2 billion in tariff costs, with full-year earnings more than halving, which shows you the real-world impact of trade tensions. On a more positive note, Siemens boosted its outlook as AI orders are pouring in and its software business is defying the gloom. So we're seeing winners and losers in this environment. The bond market is also telling an interesting story. There's apparently insatiable demand for bonds right now, and even risky borrowers are reaping the benefits of this environment. That's creating some questions about whether we're seeing too much complacency in credit markets. And then there's this unusual story out of Israel where individuals were charged with using classified intelligence for polymarket bets, which raises all sorts of questions about information flows and market integrity. What I'm seeing from a trading perspective is that markets are becoming increasingly selective. You can't just buy tech and expect everything to work. You need to understand which companies have the infrastructure advantages, which ones are managing their cost bases effectively, and which ones might be overextended. The volatility we saw earlier this week, with the Dow's 3-session winning streak ending on new AI worries, shows that sentiment can shift quickly when these infrastructure questions come up.
That selectivity you're mentioning seems critical right now. The infrastructure constraints around AI are something we haven't really had to think about at this scale before. Steve, let's turn to the economic picture. We've had some significant data releases recently. What are you seeing in the numbers?
Thanks, Robert. The economic data we've been getting has been quite strong, actually stronger than many expected, and that's creating an interesting dynamic for the Federal Reserve. We saw a major jobs data beat recently that really caught the market's attention, and the reaction to that has been notable. The odds of a Fed rate pause are now nearing 95% according to market pricing, which tells you that traders believe the economy is strong enough that the Fed doesn't need to be in any hurry to cut rates further. When we look at inflation data from around the world, we're seeing some interesting divergences. India's January retail inflation came in at 2.75% in the first print under their new data series, which is relatively benign. That's the kind of number central banks like to see because it gives them flexibility. The jobs market strength is really the headline story, though. When you have employment data coming in that hot, it changes the entire calculus for monetary policy. The Fed has been in a position where they've been trying to balance keeping the economy growing while making sure inflation stays under control, and strong jobs numbers suggest they've got more room to keep policy where it is. What's particularly interesting is how the market is interpreting this. You might expect that strong jobs data and higher odds of rates staying elevated would be negative for risk assets, but we're actually seeing resilience in many areas. That suggests investors believe the economy can handle current rate levels without tipping into recession. Looking ahead, the key question is whether this strength continues or whether we start to see some softening. The Fed is clearly in a data-dependent mode, which means every release matters more than usual. If we continue to see strong employment and sticky inflation, the timeline for any future rate cuts gets pushed further out. On the other hand, if we start to see cracks in the labor market, that could change the conversation quickly. For now, though, the message from the economic data is one of resilience, and that's keeping the Fed on hold.
That resilience is definitely the theme we're hearing from the data. Now, Lizzie, let's talk about our stock of the day. You've been looking at Kraft Heinz, which has had quite a journey over the past year. Walk us through what you're seeing there.
Absolutely, Robert. Kraft Heinz is trading at $24.99, and this is a company that's really at a crossroads right now. Over the past year, the stock is down 7.46%, and it's currently trading about 25% below its 52-week high of $33.35. So the first question is, why has it sold off so much? And the second is whether there's opportunity here. Let me start with the challenges because they're significant. The company reported fourth quarter results recently, and while they beat on earnings per share at 67 cents, versus 61 cents expected, they missed on revenue. More concerning is that North America retail organic net sales were down 5.2%. Which tells you volumes are under real pressure. The new CEO, Steve Cahillane, has been remarkably candid about the issues. He's acknowledged that the company suffered from a decade of underinvestment in its brand portfolio, which has weakened their competitive positioning. They had announced plans to split the company back in September, but they have now reversed course and decided to focus on operational fixes instead. That reversal disappointed some investors who were hoping for value to be unlocked through separation. JP Morgan downgraded the stock to underweight, with a $22 price target, which implies about 12% downside from current levels. Their concern is that the volume declines will continue and that the turnaround will take longer than the market expects. Now here's the other side of the story. The stock is trading at a price-to-book ratio of 0.71, which means you're buying it at a 29% discount to book value. The forward PE is only 10.76, which is well below what you typically see in consumer staples. The company generated $3.7 billion in free cash flow in the fourth quarter alone, up 16% year over year, so they're still a cash generation machine. The analyst consensus price target is $26.29, which implies about 5% upside from here. And the recommendation is hold. What I think is happening here is that this is a show me story. The valuation suggests there's a floor under the stock because you're not paying much, but investors want to see evidence that management can actually stabilise volumes before they're willing to pay more. For existing shareholders, I think you hold and give the new CEO some time to execute. For new investors, you might want to wait another quarter or two to see if those volume trends start to stabilise. The risk-reward feels balanced here. You've got 5 to 10% upside if things go right, but similar downside risk if the operational trends don't improve. This is a value play for patient investors, not a growth story.
That's a really balanced assessment. It sounds like the valuation provides some support, but the operational questions are real. Now let's shift to crypto. Lizzie, what are you watching in the digital asset space?
The crypto market has been quite volatile recently, and we're seeing some interesting divergences between the major coins. Let's start with Bitcoin, which is the one everyone watches. Bitcoin is showing a neutral to slightly bearish sentiment right now. We saw some positive news with Binance converting $1 billion into Bitcoin for their SAFU emergency fund, which is their safety net. And that conversion represented about 15,000 BTC. ARK Invest also added $34 million to their Robinhood stake, as Bitcoin fell below 66,000. However, the futures data is showing that bears are gearing up for a potential assault on the $60,000 level, and Bitcoin's rebound hype has faded as range highs have crumbled. What's particularly notable is that last week's sell-off delivered Bitcoin's biggest realized loss ever, which is a significant bearish signal, though we are starting to see some bottoming indicators grow. Bitcoin's reaction to that strong jobs data we discussed earlier was interesting. You'd typically expect strong economic data to be negative for Bitcoin, since it reduces the urgency for rate cuts. But Bitcoin has shown signs of resilience and is defying what's being called extreme fear in sentiment indicators. Denmark's Danske Bank announced they're allowing clients to buy Bitcoin and Ether ETPs, which is another sign of mainstream adoption continuing. For the week ahead, I'd say Bitcoin is in a neutral to bearish posture, with that 60,000 level being critical support to watch. Ethereum is looking more constructive. There's talk of Ether being set for another V-shaped recovery, according to Tom Lee. And we're seeing interesting developments on the technology side. Ethereum developers are suggesting using zero-knowledge technology to anonymize AI use, which could be a significant development for privacy. Chainlink feeds just went live for Ondo tokenized US stocks on Ethereum, which shows the ecosystem continues to expand into real-world assets. The sentiment around Ethereum is bullish, and I think it's got a better setup than Bitcoin for the next week. Solana is in a neutral to bullish position. They're leaning into tokenization and payments based on their recent Accelerate APAC event in Hong Kong, which shows they're continuing to build out use cases. Solana doesn't have as much coin-specific news as the others, so it's likely to track the broader market. But the fundamentals of ecosystem growth remain solid. Overall, the crypto market is in a bit of a wait-and-see mode. Bitcoin needs to hold 60,000. Ethereum looks like it has momentum. And Solana is steady. The macro backdrop with rates staying higher for longer is creating some headwinds. But we're also seeing continued institutional adoption, which provides support.
It's interesting how each of these major cryptocurrencies is developing its own narrative and use case. Well, that brings us to the end of today's show. We've covered a lot of ground, from the infrastructure challenges facing the AI boom to the strong economic data that's keeping the Fed on pause, from Kraft Heinz's operational turnaround story to the diverging trends in crypto markets. The theme I'm taking away from today is that we're in an environment where selectivity and patience are going to be rewarded. Whether you're looking at traditional equities or digital assets, understanding the specific dynamics of each opportunity matters more than ever. Before we go, I want to remind everyone that the content we discuss on the Morning Bell is for informational and educational purposes only. Remember, do your own research and consult with financial advisors before making investment decisions. Thanks for joining us today. I'm Robert, and we'll see you tomorrow on The Morning Bell.